Hello and welcome to this video. In this video, we are going to do a A-level question from paper 3, May-June 2023, variant 31 and 33, both are same. So this question appeared in both the variants. Question 1. The question states that Alan and Betty had been in partnership for many years, sharing profit and losses in the ratio of 3:2. The capital contributed by each partner was Alan $300,000 and Betty $240,000. The interest on capital is calculated at 4% per annum. The business was acquired by J Limited on 1st April 2022. J Limited took over all the assets except the bank account. The following information related to the business takeover was available. Book value and the value amount. Premises $308,000 and the value which they have given is $330,000. Equipments $85,000 and $73,000. Inventory $64,000 and the value at which J Limited has taken over is $77,000. And the trade receivable are $92,000 and the value amount was $90,000. So when we total the book value, we get $549,000 and value amount is $570,000. The value of goodwill was twice that of partnership's profit for the year ended 31st March 2022. Some information relating to partners' current account for the year ended 31st March 2022 was as follows. Balance at 1st April 2021, Alan was 7,000 credit, drawings are 32,000 and the residual profit share is $24,240. Betty, the balance at 1st April 2021 was 2,600 credit, drawings are $34,000 and the residual profit share is $16,160. The partnership paid $37,000 in full settlement of trade payable of $39,000 on 31st March 2022 out of the partnership's bank account. The purchase consideration was settled as follows. Both partners received sufficient 8% debentures to give the same amount of interest on capital as they have been entitled to in the partnership. Each partner received 150,000 ordinary shares of $1 each. These shares had a value of $1.30 per share. The balance was settled in cash and paid in the partnership's bank account. The partners also agreed that if there was any deficit on partner's capital account, the partner would pay cash in the partnership bank account to make up the deficit. In the A bit of the question, we are asked to calculate the partnership's profit for the year ended 31st March 2022. You see, the information which was given about the profit was the information related to the current account, where it was mentioned how the profit was shared between Alan and Betty, or how the residual profit was shared between Alan and Betty. You see, where do we get this profit where we share it between the partners? This part comes under appropriation account. In appropriation account, what we do, we take the profit for the year. From there, we subtract the interest on capital which we have to pay to the partners, and then after doing that, what we do is whatever is the residual profit, it will be divided among the partners. So here what happened is they have given us the last part of the information, that is the residual profit, and we also know the interest on capital, but we don't know the profit for the year. So we are going to solve it in the reverse order of appropriation account, that is we are going to take the share of the profit which is divided among the partners. To that we will add the interest on capital, hence we will get the profit for the year. So for the solution, we will start with the residual profit, or the profit which was shared between Alan and Betty, which was given in the information of current account. For Alan it was mentioned as $24,240. For Betty it was mentioned as $16,160. The interest on capital, it was mentioned that they will be paid 4% interest on capital, and for Alan the capital was $300,000 times 4%, which will be $12,000, and for Betty it is $240,000, which was her capital, times 4%, we get the value as $9,600. So when we add all this, we get the profit for the year as $62,000. In the B bit of the question, we are asked to prepare the partner's capital account to show the closing entries. You see, as we have to show the closing entries for partners capital account, what we have to do is we have to get the current accounts balance and mention it in the partners capital account. Apart from that, the purchase consideration, that is the debentures which have been issued for the purchase of the business, the shares which have been issued for the purchase of the business, all have to be mentioned when we are making the closing entry for the capital account. So let's start with the working notes, where we'll do all the calculations required for the partners capital account. Then we'll proceed and make the partners capital account. You see, there are two ways in which we make the partners capital account. That is, some firms, what they do is all the entries which are related to the capital account will be mentioned in the capital account itself, and the partners capital account keeps fluctuating. However, some other firms, what they do is, as the firm which we have here, they maintain a fixed capital account, and all the entries which are related to the capital account will be maintained in the partners current account, and hence the information is given here related to the current account. So now, as we want to go for the closing entry, the balance of the current account have to be transferred to the capital account so that we can close the partners capital account. Now you see the information which was given on 1st April 2021. The balance, which was the credit balance, which we are going to bring down, is 7,000 for Alan and 2,600 for Betty. You see, based on our accounting equation, whatever increases our capital will be credited, and whatever decreases our capital will be debited. So here we have interest on capital, which was calculated in the A bit of the question, and as this increases the capital, hence it is credited here as $12,000 for Alan and 9,600 for Betty. Then the share of profit, this is also a part of capital, and this increases the capital. Hence for Alan it is $24,240, which is credited because it increases the capital, and for Betty it is $16,160, which is credited. Now the drawings will reduce the capital, hence it is debited. For Alan it is $32,000 and for Betty it is $34,000. Now let's balance the account. Here for the total for Alan's column will get as $43,240, and here we have drawings only of $32,000. So the balancing figure will be $11,240 will be on the debit side, and this will be the balance carried down. And in the capital account, as it is debited here, it will be credited there. So with that we will complete the double entry for Alan. And for Betty, if we see the total here which we are getting is $28,360 on the credit side. So we have a deficit here which will be the balancing figure of $5,640 on the credit side for Betty, because we have drawings more than whatever is the total for the current account column. So because of this there is a deficit, and hence we are getting the balancing figure on the credit side. So as we have the balancing figure, that is balance carried down on the credit side here in the current account, in the capital account it will be debited as the balance brought from the current account. Now after understanding how we'll complete the double entry, what we are going to do is we are going to total both the sides of the partners current account, and that will complete the partners current account. If you want, you can make the current account, or else you can just do it like this. That is, you can write Alan's current account balance, which has been given as 7,000 as credit balance, and whatever increases the capital, that is the interest on capital as well as the share of profit will be added, and the drawings will be subtracted, and you will get a credit balance of Alan's current account which is positive as $11,240. And for Betty you can take $2,600 which was given, plus the interest on capital, plus the share of profit, and when you subtract the drawing you will get a negative value, and that will show that this is the debit balance which will be mentioned in the capital account for Betty. Next we have to calculate the number of debentures which is issued when the partnership is taken over by J Limited. You see, it was mentioned that in the purchase consideration Alan and Betty will be issued the number of debentures based on the interest which they are earning per annum. They will earn the same interest per annum when the debentures are issued. So how much interest Alan was receiving based on his capital account, that is $300,000. We have calculated 4% of interest in our A bit of question, where we get the interest as $12,000 for Alan. Now what we have done, we have taken this principal amount which is our capital. With this we have multiplied the interest rate to find the interest which Alan was receiving. Now we don't know this principal amount which will be the amount of debentures which will be issued. So this times now the new interest rate for debenture which we are saying will be 8%, and Alan should receive 12,000 per annum as he was receiving previously. So what we will do is to find this principal amount, that is the amount of debentures which we don't know. For this what we are going to do is we are going to transpose this 8% which is in multiplication here to the other side, and it will be in division. So we have done that here, and when we do this we get the amount as $150,000. This will be the amount of debenture stocks which will be issued to Alan. So I've mentioned here the amount of 8% debenture stock which will give Alan 12,000. Interest per annum on the capital of 300,000 will be. So this is one way of calculating which I have explained above. Now this is the other way in which we will calculate it. That is, we can take 300,000 times the old interest rate which was for capital 4% divided by the new interest rate, that is the interest on which we are going to pay Alan for his debentures. If we do this way also, we'll get the same amount as $150,000. So for this we can make a formula, that is the amount of debentures if you want to find when we are buying a partnership firm for purchase consideration. What we can do is we can take this, that is if they have to pay the same interest for the debentures as the partner was earning previously, then for this we will take the principal amount. This principal amount can be the partner's loan which have been given on interest, or the interest on capital if we are talking about capital. So this will be the partner's capital times the previous interest rate divided by the new rate of interest. So this is how we have done. 300,000 was the principal amount. The previous interest rate was 4% and the new interest for debenture is 8%. So the total amount of debentures which will be issued will be $150,000 for Alan. Now debentures to be issued to Betty. What we are going to do is we are going to take Betty's capital which was $240,000 times 4%, which we have calculated in the ABIT as well, and we got this as $9,600. So now we want to find the amount of debentures on which Betty will get the same interest per annum, that is $9,600. So again we are going to do the same way as we did for Alan. It is the principal amount times the interest rate is equals to interest, and now the interest rate for debenture is 8%. We don't know the amount of debentures which we have to issue, and the interest rate which Betty should get is $9,600. So again we will transpose 8% to the other side. So the principal amount which we will get is 9,600 divided by 8% will get as $120,000. Or we can do it with the formula which I have stated, that is debentures is equals to principal amount times the previous interest rate divided by the new rate of interest. So it will be 240,000 times previous interest rate was 4% for the capital, and now the new interest rate for debenture is 8%. So 4% divided by 8% will get the value as $120,000. Then ordinary shares were also issued to fulfill the capital requirement for Alan, and it was 150,000 shares, and the share price was $1.30, which is equals to $195,000. Ordinary share capital for Betty in the same way was 150,000 shares times $1.30 will get the value as $195,000. Furthermore, additional information was provided which states that the balance was settled, that is for purchase consideration after the payment of debentures as well as the ordinary shares. The remaining balance was settled in the form of cash, and this was paid into the partnership bank account. You see, next we have to also calculate the realization profit or loss to complete the capital account for partners. So you see, whenever there is a purchase consideration given, then it becomes easy for us to make the realization account and calculate the realization profit or loss. However, here the cash settlement which was done for purchase consideration was mentioned just as a statement and the amount was not given. The amount of cash which was paid for purchase consideration, if we had that information, then we could have made the realization account. As we don't have that, now what we will do is we will find the realization profit or loss in the following way. You see, what is realization profit? When the partners have invested in the assets, if they are able to sell these assets at the time of the closure of the company at a higher rate than what they have invested, then it will be a realization profit. But if they were not able to sell the assets at a higher price than what they have invested, then there will be a realization loss. Here we have realization profit. Why? Because the book value of asset was $549,000 and these assets were taken at a price of $570,000. So if we subtract this, that was this value at which the book assets were taken was more than the book value of the assets. So we'll get the realization profit for the taking over of the assets as $21,000. Apart from that, it was also mentioned that there was a goodwill. What is goodwill? Goodwill is the price which the purchasing company is willing to pay more than the value of assets because of the good reputation of the company, and hence this is also a part of our realization profit. It was mentioned that the goodwill will be twice the value of the profit for the year, and the profit for the year which we have calculated in our first EBIT was $62,000, and $62,000 times 2 will be $124,000, and this will also be a part of our realization profit because we are getting this value more than the value of assets. Now apart from that, it was also mentioned that when the liabilities were released, that is trade payable was released, they got a discount of $2,000. So this discount is also a profit. So when we add all this, we get the profit from realization as $147,000. Now this profit on realization will be shared between Alan and Betty in their profit and loss sharing ratio, which was 3:2. So for Alan, it will be $147,000 times the profit share is 3 and divided by the total, which is 3 plus 2, 5. So it will be $88,200 for Alan, and for Betty it will be $147,000 times 2 divided by the total, which is 5. So it will be $58,800. Furthermore, it was also stated that the partners also agreed that if there was any deficit on a partner's capital account, the partner would pay cash in the partnership bank account to make up for the deficit. Now let's make the partner's capital account. You see, capital and liabilities will always have the opening balance on the credit side. So we have brought down the balance on the credit side. For Alan it is $300,000 and for Betty it is $240,000. Then we made the current account in our first working notes, where I have mentioned when there is a debit balance carried down in the current account, it will be credited in the capital account. So here we have the current account for Alan, which was $11,240, and for Betty it was a credit balance. Now we are debiting it to complete the double entry. So here we have the current account balance for Betty, which was $5,640. So with this we have completed the double entry. Then we have the profit on realization, which we have calculated in the third working notes, and as this increases the capital, hence it is credited. So it is $88,200 for Alan and $58,800 for Betty. Then this capital was paid by means of debenture, which we have calculated in the second working notes. For Alan it was $150,000 and for Betty it was $120,000. Apart from that, even ordinary shares were issued to compensate the capital. So it is $195,000 for Alan and $195,000 for Betty, which was calculated in the second working notes. Furthermore, it was mentioned that wherever there is a deficit or the balancing figure, it will be paid by means of the bank account, and we are going to find what will be the balancing figure so that we can find what will be the amount which will be paid through bank. Now for balancing, when we total the credit side of Alan's account, we'll add $300,000 plus $11,240 plus $88,200. We'll get the total as $399,440, and On the debit side, we have $150,000 plus $195,000, which will be $345,000. So here we have more, that is $399,440 from there. If we subtract $345,000, we will get the value as $54,440. It was mentioned that wherever there is a deficit, it will be paid by means of bank. So this will be bank and the balancing figure, which will be $54,440. So now both the side total, that is from the debit side and for the credit side for an account, is same, that is $399,440 and $399,440. Now let's balance Betty's column. Here we have on the debit side $5,640, $120,000, $195,000. So when we total it up, it will be $320,640. Then on the credit side, we have $240,000 and $58,800. So when we total this, we get the value as $298,800. So we have a balance which is less on the credit side, that is $320,640 minus $298,800. The deficit is $21,840, which will be the balancing figure. And as we have mentioned that the deficit will be paid by means of bank, and as Betty's capital is less than what she is getting by means of shares and debentures, so she has to pay this amount in the bank account. And now when we total both the sides of the Betty column, we will get the total as $320,640 on the debit side as well as on the credit side. So with this, we have completed the partner's capital account. In the C bit of the question, we are asked to calculate the amount paid by J Limited into the partnership bank account. For this, we'll start with the purchase consideration. It was mentioned the value of assets which was taken over, and this was given as $570,000. And it was also mentioned there was a goodwill which we have calculated, and it was twice the profit for the year, which we got as $124,000. And this is the total amount which they have to pay for purchasing the partnership firm of Alan and Betty. So for this, what they have done, they have already paid the debentures, 8% debentures. Alan we have calculated as $150,000, and for Betty we have calculated it as $120,000. So the total is $270,000, and this we will subtract because this is paid in the form of debentures. Then we have the ordinary shares which they have issued to purchase this partnership firm. For Alan, they have issued $195,000 of ordinary share, and for Betty they have issued $195,000 of ordinary share. So when we total this up, we will get as $390,000. So now this is paid by means of ordinary share capital, hence we will subtract this as well. So from $694,000, when we subtract $270,000 and $390,000, the balancing value will be $34,000, and this is the amount of cash, because this is the balance which is left over after the payment of purchase consideration by means of debentures and ordinary shares. So this will be the amount which J Limited have paid into the partnership bank account to fulfill the purchase consideration. In the D bit of the question, we are asked to prepare the partnership bank account recording the closure of partnership. You see, it was mentioned that when J Limited had taken over the partnership firm, they have taken over all the assets except the bank account, and the bank balance was not given. So we have to first calculate the opening bank balance, and we will do it by taking the accounting equation, that is assets equals to capital plus liability, and this assets consists of the assets which have been taken over plus the bank balance which was not taken over, because this was the only exception, which will be equal to capital plus liabilities. So if you want to calculate the bank balance, we'll take the assets taken over to the other side, and it will be subtracted from capital and liability. And here we have to make sure that the capital which we are talking about, because this is the partnership firm with the fixed capital account, so we have the partners capital account plus current account for the capital account. Now let's do the calculation. We'll start with the capital account. For Alan it was $300,000, and for Betty it was $240,000. So the total will be $540,000. The current account balances which we have calculated for Alan, it was $11,240, and for Betty it was negative $5,640. So we'll get the total as $5,600. The trade payables which was mentioned was $39,000, and when we total this up it will be $584,600. And the book value of the assets, because we are calculating this for the partnership firm, so it will take the book value of all the assets which was given as $549,000, which we will subtract, and we will get the opening cash balance for the partnership firm as $35,600. Now we'll start making the bank account. You see, assets will have the opening balance as debit balance, and hence we have mentioned it here as balance brought down, which we have calculated in our working notes as $35,600. Whatever will increase our bank balance, we are going to debit it, and whatever is going to decrease our bank balance, we are going to credit it. So J Limited have paid for the purchase consideration into our bank account, and this will increase our bank balance, hence it is debited as $34,000. Betty have paid into the bank account for the deficit of her capital, and as this is paid in the bank account, which increases the bank balance, hence it is debited as $21,840. This was done when we made the partners capital account, where we have got the balancing figure, and then whatever decreases our bank balance will be credited. So we have paid our trade payables, as this is a payment, it will reduce the bank balance, hence it is credited as $37,000. And even Alan have to be paid for the deficit of his capital, and this was also calculated in our partnership capital account which we have made. So the amount was $54,440. So when we add the debit side, we'll get the total as $91,440. When we add the credit side also, we'll get the same total as $91,440. So we have closed our bank account. Furthermore, additional information is provided which states that the partnership business of Alan and Betty was the first business acquired as a part of the expansion strategy of J Limited. In a meeting to review the result of the acquisition after 1 year, the finance director reported that the acquisition of the partnership business did not bring the expected additional profit to J Limited. In the EBIT of the question, we are asked to advise whether or not J Limited should continue the expansion strategy, and we have to justify our answer. You see, whenever a business purchases other business, this may be because they may be thinking of eliminating the competitors, and when they eliminate the competitors, this may lead to more profit. However, after considering, after the first year of acquisition, they have come to know that they have not earned the expected profit. So this may be because when two businesses comes together, they are different organization cultures which each business may have, and when they come together, there may be clashes in the organization culture which may lead to demotivation among the employees. So this may be one reason. Apart from that, they have paid a huge amount of goodwill, that is, they have paid the twice of the profit for the year which the firm was earning. So this was too optimistic, and because of this also they may not have earned the expected profit after the first year of acquisition. And as this is the initial phase where two firms are coming together, I don't advise J Limited to go for the expansion policy right away, because still they require some time to get the expected profit. So in the long run, maybe after some years they may go for expansion, but right now they need to settle down and adjust the two organizations which have come together so that they can earn the expected profit. So I do not advise J Limited to further go for the expansion policy as of now. With this, we have completed this question. Thanks for watching my videos. Have a peaceful and blessed life.